Worries for a global economic downturn and low demand prospects for the commodity are still present, yet the overall supply side for oil seems to be tightening and is pushing oil prices higher. In this report, we aim to shed light on the factors driving WTI's price and assess its future outlook. We make a start with the latest data concerning the US oil market. At the end of the past week, Baker Hughes reported that the number of active oil rigs dropped by 8, reaching 512, a continuance of the declining course of the indicator. The drop is not to be considered as a positive signal for oil prices, as it would imply lesser demand in the US oil market. Yet the overall picture was overturned as the American Petroleum Institute reported a wide drawdown of around minus 11.4 million barrels, which showed that demand was able to surpass production levels. Similarly, the Energy Information Administration's crude oil inventories figure also indicated a substantial drawdown of around minus 10.5 million barrels. The data tended to highlight that the tightness of the US oil market, as reported by the previous week's figures, and overall could continue to provide support for oil prices should they continue to paint the picture of a tight oil market. Yet the tightening of the supply side of the international oil market seems also to be maintained, as analysts tend to expect Saudi Arabia to extend its voluntary oil production cut of 1 million barrels per day well into October, as reported by Bloomberg. In the survey, it seems that only a minority of participants expect the Saudi kingdom to taper the oil production cuts and none to widen it. The Saudis are expected to announce such an extension in the next few days, and given the fragile nature of the oil market currently, could have a substantial impact on oil prices. Such a move, in combination with the oil production level cuts decided by OPEC along with Russia, may intensify the bullish sentiment in the market for oil. At this point, it would be useful to point out that analysts have mentioned that US sanctions on Venezuela seem about to start easing, and such a scenario may have a negative effect on oil prices, while Iranian oil seems to be flowing towards China, which in turn could also weaken oil prices. Yet gains for oil's price seem to have been clipped by market worries for the demand side of the commodity, and especially from China. China, which is a key oil consumer, seems to be facing headwinds regarding the recovery of its economy. It's characteristic that the National Bureau of Statistics released the manufacturing PMI figure for August today. The indicator's reading improved, yet remained below the reading of 50, implying another contraction of economic activity in the Chinese manufacturing sector. The key takeaway here remains that Chinese factories continue to struggle since early spring, despite the lift of the Chinese government's strict restrictions at the beginning of the year. Hence, the issue may turn into a structural problem for the Chinese economy. Also, the Caixin manufacturing PMI figure is to be released tomorrow, yet we do not expect the overall picture to change dramatically. Given that manufacturing production is facing difficulties, as may also be the construction sector in China, we would expect it to have an adverse effect on oil prices, as demand for oil seems to remain lower than initially expected in the coming months.